What's up, everybody? My name is Joe Brown. This is Heresy Financial, and today we are talking about IPOs and why it looks like the IPO bubble has popped, despite the fact that 2021 has had a record number of initial public offerings, companies going public. We are starting to see a massive collapse in the prices of these stocks. So that's what we're going to take a look at today. Ready? Let's dive in. All right, take a look with me at this article from the Wall Street Journal. They've got some good charts on this article that we are going to be taking a look at today. So this first one here, we are looking at a chart of the number of IPOs, or percent, I should say, the percentage of all IPOs that are trading above their IPO price. So at the beginning of 2021 here, you can see back in January until today, which is basically almost the end of the year here, we have just seen a pretty steady decline in, as more and more companies IPO and as they stick around for longer and longer, their stock prices start drifting down till we get to today, where only 34% of IPO stocks are trading above their IPO price. That means about 2/3 of IPOs from 2021, about 2/3 are trading below the price that they went public at. Now, let's take a look at this chart. Hold on here. Okay, let's take a look here, and we can see at the beginning this nice little interactive graphic here that they have. We can see that in the beginning of the year, as IPOs started coming out, we saw most of them, in 2021, think back to the beginning of the year, IPOs that were coming out, they were doing quite well. Most of them were staying above their IPO price. They were some money makers. As we go forward through, about halfway to the year, we still have a nice percentage above the IPO price, but we're starting to see more and more drop below that line. And then as we fast forward through the end of the year, especially this last quarter here, we can see a big migration south of the line there till we get to the point today. You can see here, these are, all the stocks that are still trading above their IPO price. And then we have a lot more, 255 so far this year, that are either even or down from their IPO price, and only 129 as of December 28th that are above their IPO price. So why is this happening? Well, there's really one main reason, and it's different than what the Wall Street Journal is talking about here, although they get kind of close. So if you look at the article, you'll see that they mainly blame the fear of interest rates rising soon. A rising interest rate environment is kind of a risk-off environment traditionally, according to modern economics, where you'd have a time where people are being more careful with their money, and IPOs are traditionally a little bit more risky. It's, hey, here's a startup, here's a younger company, we're going to pump some money in, hopefully they're going to make a lot of money, take a lot of market share down the road. And so moving into an interest rate environment where interest rates are going up is one where people start to pull back on that. They get close. Basically, what's going on here is classic Austrian business cycle theory, where when you have an expansion of the money supply, there are typically two reasons for that, both enabled or funded by the central bank. One of those is through fractional reserve banking. Banks do not, when they lend you money, they're not lending you somebody else's money. It's not like when you swipe your credit card, that's money that was in the bank's account that gets transferred then into your account, then transferred to the store that you just bought something from. When you swipe your credit card, that money just came into existence. It is loaned into existence. That money that you spent did not exist before you swiped that card. Once you swipe that card, now that money is in the account of the person that you bought that thing from, and that money will exist now. That'll be in circulation. And then when you pay off that loan, you are destroying, on net, you're destroying money. You're taking it out of circulation because you're paying down that loan. Right now, you've got $1. You just bought $1 with a credit card. That means there's $2 circulating right now. And then when you pay off that loan, now you don't have $1, but they still have their $1. So you're when you swipe a card, when you borrow money, when you buy a house, when you buy a car with an auto loan, lending money into existence through the banks is how the money supply expands. That's process number one. And the reason why that's enabled by the central bank is because obviously that's a Ponzi scheme. That's something that cannot continue into infinity. And so the banks have to be backed up by somebody, and that is the central bank. And so when a bank gets into trouble, they make too many loans or bad loans, and there's used to be run on the banks. They're backed up by the central bank, who can do the same thing, create money out of thin air, lend it to the banks, and back them up that way. And now that we're in a situation where the central bank can print money, they don't have to have it tied to something like gold reserves. Now you have an unlimited money printer through the banking system through fractional reserve banking. So that's one way money is created. The other way money is created is through government spending. Normally, when governments spend money, they spend what they bring in from taxes. In the United States, we haven't brought in enough money from taxes to support the spending in a very, very long time. So the rest of it is made up from borrowing. Now, normally they're borrowing that from institutions, from savers, from investors. Sometimes, though, the economy runs out of an appetite to lend to the government, and then the government still needs to borrow to make up the difference between what it's spending and what it brought in from taxes. So it has to borrow from somewhere, and that's where the central bank steps in. So this last 2 years, when you saw the Federal Reserve's balance sheet expand by $4 trillion almost, what you saw was the Federal Reserve printing money to buy treasuries, which is a roundabout way to create dollars to lend directly to, or indirectly, I should say, to the federal government. So the federal government taxes the economy to its capacity, and then borrows from the economy to its capacity, and then borrows from the central bank, which prints that money into existence. And then so the government's really spending money into existence that way. So that's the two ways that new money comes into existence: from spending it into existence from the government, and fractional reserve banking, where the banks lend money into existence. Over the past 2 years, we've seen the money supply expand by 20-30%, depending on where you are. And as that new money comes into existence, you have a false boom take place, because that new money gets into the hands of people who want to spend it. They buy assets and they buy goods. A lot of people will invest a lot of that money. So this money works its way throughout the economy, and for a short period of time, economic actors feel very wealthy, feel very rich, because there's this influx of spending power. But what is not happening, what is not true, is an increase in purchasing power. The same amount of purchasing power exists after the money is printed as there existed before the money was printed. You don't have more purchasing power on net in a system just by doubling or tripling or quadrupling the money. You have the same amount of purchasing power, it's just measured differently. Instead of $1, now it's $4, but those $4 can buy the same stuff as before. So because you have this false sense of wealth, this false sense of an increase in purchasing power, you have a lot of spending take place, a lot of investments are made, a lot of purchases are made from this false signal that the monetary expansion sends to the economy of abundance. And so all this extra money is sending a signal to economic actors saying, hey, the savings pool is large. Go out and risk your money, take on debt, spend money, take on risky projects, because there's enough capacity to do so. But in reality, there was no change in the actual purchasing power. There's just a change in how it was measured. This means that all of that spending, or not all of it, but a lot of that spending, is a misallocation of resources. You're spending money on projects you shouldn't be spending money on. There are not enough resources to bring that project to completion. There's not enough money in the system to make that project profitable. And so what you have, this giant IPO boom as a result of all the money printing, a lot of it is a misallocation of resources, malinvestments here, where as soon as these investments are made, pretty soon people are realizing, oh, we actually need more money because the dollars aren't going as far as they used to, and all of the profits or expected profits are not showing up there for these new investments, these new projects, and they start to suffer, especially now that we are entering into a time of tightening, a time of tapering, where the Federal Reserve is getting a lot of pressure to get inflation under control. They're going to be reducing their asset purchases, which is lowering the amount of new money that's going into the system, and raising rates, which is disinflationary or deflationary, depending on how severe those interest rate hikes get. Because just as lowering interest rates makes it easier for the monetary base to expand through lending more money into existence, Raising interest rates causes debt to be paid off. And just like in the example of the credit card swiping, when debt gets paid off, that reduces the amount of money that is in circulation. That's deflationary. And so you have this tightening taking place right as these projects are starting to, rear their unprofitable heads. And this is one example of, or an early domino to start falling in this crash that I think will happen sometime in 2022 as a result of this tightening that had to take place after this massive monetary expansion. So that's what's going on here with the IPO bubble, massive IPO bubble, tons of IPOs, tons of money rushing in, and then they're all starting to fall apart and collapse to the point where now we've got, 34% of all IPO stocks as of today of 2021 IPOs are trading above their IPO price. Everything else is below it. So not a good sign going forward. As always, really appreciate you guys. Thank you so much for watching. Have a great day.